Mr. Sandeep Ghosh, Mr. Gadge, Mr. Bihari Lal, delegates to this second edition of the Credit Summit. At the outset, I must say I'm very, very happy to be here. As Sandeep said, we began at the Reserve Bank almost together. He followed me there, and we are very close friends. So any request from him I couldn't refuse. But more than that, I'm only very keen to come here to say a few words on the issues that I thought would be of interest to people. In fact, as Sandeep said, I was actually mulling over what should I speak on this at this event. If you look at the major areas of discussion today of the banking sector, for example, in particular, the general discussions hover around stressed assets, the growth of stressed assets in India in general, and of course, more particularly in the public sector banks. So I thought there are many reasons why the stressed assets have reached the levels that they have reached today, but I thought it may be interesting to dilate a bit on the concept of credit culture. Fundamentally, of course, from the point of view of the lending institutions, because I think it's an important ingredient of ensuring that the loans that are made are based on certain principles. But perhaps I'll also try to widen the arena to look at the larger issues of credit culture from a society's perspective as well. Bihari Lal referred to the Gopalakrishna committee in his presentation. You must be aware that the Financial Sector Legislative Reforms Committee had, FSLRC as it is known, had talked in terms of certification of people in critical areas in various financial sector regulatory entities, and also in regulated entities per se. So actually this Gopalakrishna committee was constituted in the Reserve Bank to dilate that further and see what needs to be done. And the committee's report we have studied, and we are in the process of taking certain important decisions on the recommendations of the committee, including with regard to at least looking in terms of certification as a requirement for people working in certain specified areas. So that's in the works, so I'm not able to tell you more than that at this moment in time, but we're very, very close to taking that forward. Credit is a very critical part of an economy's growth story. And in a country like India, the role of financial intermediaries in general and banks in particular in providing funds needed by the business can hardly be overemphasized. At the same time, as I said earlier, we are also aware that the Indian banking system is today beset with the issue of dealing with stressed assets. I'm aware that numbers about stressed assets keep coming off and on, but I thought to provide a context to the discussion that I have in mind, I thought I should quote what the Financial Stability Report recently talked. The gross NPS of the banking system is about 7.8%, and add to that the non-NPS stressed assets. Together we are looking at a stressed assets of close to 11.5%. When you say the non-NPS stressed assets, they are the restructured standard assets. And what we have found is that in the last 2 quarters, there has been a migration of advances accounts from what was the standard stressed assets to really substandard assets. So the total stressed assets will remain same, but there's a migration from the stressed assets, which is standard, to NPA. Obviously, there are many reasons why the stress numbers are where they are, but I don't think I'm here to make a diagnosis of that. A lot of reasons are given. One of that, obviously, we have already talked, RBI has always been talking in terms of need to improve the skill levels of people, the need to improve the appraisal capacity, the need to improve the post-disbursal monitoring, and possibly some of the certificates that this process is going to give will help banks to get the right kind of people to handle that. Having said that, I think there's no gainsaying the fact that the role of a sound credit culture in developing good credit portfolio is very, very important. And therefore, I thought I'll dilate a little bit on this whole issue. The term credit culture could refer to a multitude of things, such as an attribute of the society as a whole. It could be an attribute of the regulatory architecture in the country, or it could be the attribute of the credit institution itself. So what is a culture that is informing the entire credit decision process that is there in an institution is an important part of its culture. So I'm going to explore this aspect a little more in terms of credit culture of a credit culture of a credit institution, particularly because of the high-level discussions, high-decibel discussions on the NPAs in the sector. Of course, banks are in the business of taking risks as part of their intermediation function. They fund their operations with the help of large uncollateralized public deposits and run the risk of liquidity risk if they don't handle the maturity transformation business well, and run a solvency risk if they, among others, don't manage a counterparty credit risk well. The classic model, so what is the fundamental model on which a bank functions? Because the bank is in the business of accepting deposits which are repayable on demand, and they are lent on longer maturity assets, and therefore create an asset liability mismatch is the fundamental. So there's an interesting article in the Journal of Political Economy by Diamond and Dybvig, which says that a bank's business model hinges upon the fact that the short-term individual withdrawals by depositors are uncorrelated, so that banks can expect a reasonable, stable level of daily withdrawal. So they know that mostly the withdrawals are going to be X levels, so they can manage their asset liability mismatches in that manner. But this stable deposit remains stable so long as the depositors have the trust in the bank that their funds are safe. The moment there is a doubt about the safety of funds, the stability of deposits is no more assured. In fact, at the drop of a hat of a fear of the safety about the deposits, one could have a run on a bank. And in India, we fortunately have most of the banks in the public sector, and because there is the assurance almost that the banks will be capitalized by the government, and they will, there is the fear of a run is not there. But that does not in any manner undermine the need to ensure that the credit culture of the organization is conducive to developing a very good credit portfolio and ensuring the solvency of the entity. In fact, the word, so ultimately if you look at the whole gamut of relationship between a depositor and the bank is based on the trust that my funds are safe, number one. And there is also a sense of that coming from the fact that the functioning of a bank is licensed by a regulator, is supervised by a regulator. Because I keep asking people, when you place funds in a bank, do you look at its balance sheet? Do you look at how safe it is? No. You go by the fact that it is a scheduled bank licensed by the Reserve Bank, and you place funds there. So, but it only takes very little time to lose that trust, and maintaining that trust is the most critical. And very interestingly, the Latin word for trust is creda, and the word credit has emanated from that. So if you look at in a very interesting way, the trust of a bank in a bank is going to be a function of how good its overall credit quality is, because that's the larger chunk, I think, as Biharlal said, that's the larger chunk of what banks do in most countries, and most particularly in India. Now, what do we mean by credit culture in a bank? In fact, there are some interesting definitions. Credit culture, John Cote, Altman, and Paul Narayan, they have described credit culture as collection of principles, actions, deterrents, and rewards within the lending organization. So, I was just asking, is credit culture just credit risk management? It's not credit risk management. Credit risk management may be an element of credit culture, but I think credit culture is a much larger, vast, much wider gamut of issues are covered. So, it is covered, as I said, of principles that need to be communicated. A credit culture is rooted in corporate attitudes, philosophies, tradition and standards that require administrative underpinnings. The role of credit culture is to create a risk management climate that will foster good banking. So fundamentally, what we are talking of is a credit culture is very critical to foster good banking. And that is something which is very important as almost to be a DNA of a bank for it to ensure that the credit management of the entity of the bank is on sound footing. Now, as a regulator, one way to look at it is any organization or a bank that has a well-developed credit culture which is ingrained in its all activities and therefore has a long-term view of its activities is what a regulator will look at. So one, a credit culture, a culture that permeates the entire risk-taking business and that underpins the entire decision-making process is what we are looking at. Now, a credit culture so developed could be either informal or codified in some form, though most commentators feel that it is necessary to codify credit culture. There will be very clear communication of those principles for people to follow. Additionally, as banks are also firms aiming at maximizing shareholder value, the discipline that a well-entrenched credit culture brings to the organization would also be ultimately rewarded by the market. It's a what happens is, do we actually try to articulate the credit culture? Very often it is taken for granted that we have one, but very often in the absence of what are the ingredients of that culture being articulated, it's almost that you don't have a credit culture at all. And then what happens? Decisions are taken on the basis of transient considerations rather than on the basis of fundamental principles, which should be the instructive factor in determining credit decisions. Given how integral credit culture is to the identity of a bank and to the long-term survival of the bank as well, it's imperative that the tone flows from the top. This is a fundamental principle of culture. A credit culture will be something that comes from the top, and commitment of the top, from the top to that credit culture is something that will have to permeate, it will permeate across the industry, across the entity. At this juncture, it is pertinent to note that in a recent installment of Credit Risk Management audio conference series, the Risk Managers Association had made some interesting observation. They said there are 10 elements that forge a strong credit culture. What are they? Of course, as I said, credit culture starts at the top. Everybody owns the risk. Systems and procedures must be robust. There must be room for good judgment. There is a commitment to training and education, so something very important that people here are talking about. Incentive systems should have a risk component. Core competencies should be the focus. Credit message is reinforced, and line of business growth is managed prudently. So what happens is
sometimes we always have seen this system of sometimes banks following a herd mentality. If there's one particular sector which is showing some promise, everybody joins that bandwagon without actually analyzing whether are we creating excess capacity there? Is this our business? Do we have core competence in that area? So it's something that banks need to look at. And of course, I think, therefore, and more importantly, there must be policy and limits. In fact, this is something that RBI keeps telling. If you look at the fundamental principles of a regulation, we have moved from the earlier days of intrusive regulation. We are no more prescribing things. We have moved from that type of regulation to laying down the larger principles and asking most of the principles to be laid down by the bank through the board level policies. What does a policy do? I keep asking because there are sometimes people say, this is our policy. They come to us for a change in the policy. One, people ask, if I have to come for a change in the policy, why should I have a policy? Is policy good if it can be changed frequently? Number one. Is policy good if you can't deviate from it at all? I keep saying that if policy, you cannot deviate from a policy, then you don't need various levels of hierarchy. So what I'm saying is, fundamentally what policy does is, the policy says, this is my rule, this is how I do things. But if I have to deviate, I am forced to write a reason for that. So I am supposed to make an analysis of why there is a need to deviate from the policy, and that itself is going to be a deterrent from deviation from policy. And if one is deviating from policy off and on, there's something either wrong with the organizational culture or with the policy itself, and one needs to see it internally again. Now, there are diverse cultures evolved around the loan approval and loan management processes that were built around the transaction management. Now, this led to an unplanned development of credit culture in banks in a bottom-up fashion. I said normally credit culture is from above, rather than the desired top-down fashion. In this scenario, building a robust credit culture requires that the culture is compatible with corporate priorities. That's something very, very important. So, what happens is, the credit culture has to be informed by the corporate philosophy. If it's different from the corporate philosophy, then that culture is not likely to be sustainable. Now look at the same time, sometimes the culture is also a byproduct or a subproduct of the regulations. Let me put it this way. For example, the Reserve Bank has said, if somebody says that my culture is to lend very large, okay, my system is to lend large, but now you have the regulatory prescription which says, one, you cannot lend more than X% of your capital to any single borrower. So that kind of limits. But should I therefore say that my culture is that I lend to everybody as per the limit prescribed by RBI? That cannot be the truth. So the regulation prescribes the overall framework within which one works, and in a way will have an impact on culture. So in fact, I was reading an article which said that the central banks do not directly write the culture of a bank, credit culture of a bank or an organization, but they do influence the credit culture of an organization. So an organization with a values-driven culture will generally be a strong credit organization with few policy exceptions and excellent communication. Immediate performance-driven culture generally gives strong emphasis on credit quality when economy is strong and not much difference from a values-driven culture. However, in periods of weak loan demand, there is a tendency to enter or increase riskier lines of business. So this is something one must be very careful about. Production-driven cultures give rise to well-managed, market-driven banks having strong systems, controls and good credit leadership. But as lenders are pressured to produce, line and credit will be conflict over priorities. In very aggressive banks, credit approvers find themselves increasingly limited in their influence on loan decisions as they are directed to find a way out to do the deal. So that is the kind of culture we actually do not want. So we need to be, our decision should be based on a dispassionate analysis of what is required. Now, what could be, can we define what is an optimal credit culture? Can we say what is an optimal credit culture? It may be very difficult. One way to look at it is that optimal credit culture is not one that minimizes losses, but one that provides the best credit quality consistent with management priorities within acceptable standards of performance. McKinley and Brickman also note that the strongest cultures share these characteristics. Now, in the present scenario, when a lot of talk is being done on stressed assets on the bank's books and the need for improvement in the lending practices of Indian banks, introspection into the credit culture of each bank would be a useful exercise. This is particularly important even in the public sector bank because they have the perhaps the largest share of stressed assets in their books as opposed to the others. But even within public sector banks, if you look at, there are some banks with lower NPS as opposed to the others. So obviously those with better credit underwriting qualities, better credit monitoring have been able to manage with much lower NPS as opposed to the some of the other large other public sector banks. So the one of the reasons that we find for the current poor quality of assets or a large quantum of stressed assets could be, obviously we have talked in terms of maybe the need to improve the credit underwriting standards, credit appraisal standards, and also post-sanction monitoring and collection. I think that's an important thing. In fact, at this point, I can't remember whether it was Rahim or Kabir. He had written a very good couplet, Doha, which said, of course it was reference to God, but it's a general value every time. It says, Dukh mein sumiran sab kare, sukh mein khare na koi, jo sukh mein sumiran kare, dukh kahe ko hoi. The point is that when the going is good, we don't look at, what needs to be done on an ongoing basis. I think this is, I think Biharilal referred to my time in IFC as well as the Chief of Vigilance. That is what I told my people. I said that please do not think that when the going is good, the relationship with your customer has to be on professional lines. It just can't be relationship management alone. So look at covering all aspects even when things are in good shape, so that when there are problems, that is whole principle of risk management. If one doesn't have to take care of things when things are going good, then there's no risk management. Then you are actually not managing the risk. You are dealing with the problem later. You are sowing the seeds for a crisis if you don't manage the risk. And risk management actually happens when things are good, so that you hedge for the what do you call unsavory developments at a later date. Now, the economist Paul Macaulay, who used this Minsky's financial instability hypothesis, note that human nature is inherently pro-cyclical. So, in his words, from time to time, capitalist economies exhibit inflations and debt deflations which seem to have the potential to spin out of control. Which is why, we need to be, which is why the whole talk of what do you call counter-cyclical actions need to be taken, so that you're able to deal with ups and downs in a more even manner. Which is where in particular, therefore, we can say that there's a direct kind of violation of attributes of good credit culture, which would normally would translate into poor credit management and poor credit risk management in general. Now, the other thing is, in fact, this is something that I keep pondering about. The regulation of banks, the regulation and supervision of banks is an entirely different kettle of fish as opposed to regulation and supervision of a real economy entity. Because as I said earlier, one, the banks have the ability to raise large uncollateralized liabilities, number one. Number two is that there is a kind of a conflict of interest, in the sense that I take there's always this risk-reward risk-reward kind of equation. So higher the risk, there's a chance for higher profits. But what happens in a banking industry, if I take higher risk, the profits go to capital. But if the risk actually materializes, the impact of that is felt on the depositors. So you have a situation where there's a larger public interest, public policy interest that informs the way the banks and financial institutions in general are regulated, number one. And add to that, of course, is today the larger concept of financial stability and systemic stability issues, because of which they need to regulate the banks and financial institutions differently from that of a real economy entity comes in. Because of that, so we have this conflict, and therefore it's very, very important that the management, the corporate management of a bank understands this difference, that it has, of course, today when we talk of good corporate governance, it talks of stakeholder value. I'm not denying that. Having said that, there is a bit of a much larger conflict between the need to protect the depositors on the one hand and a high risk decision that could enhance returns, but as I said, could have other deleterious consequences. Which is why, therefore, the entire gamut of factors that would inform the overall management culture in a bank will have to be much, much, much different from that of an entity. Now, I did say that credit culture is also a societal issue. One I did talk in terms of how it's important to have credit culture, good credit culture in a bank, to be ensuring that its asset quality is of high nature. But I think there are larger issues with regard to overall the societal credit culture, which is important. And I think over a period of time, institutional framework also has a big role in molding the overall credit culture in a society. I think if you look at over a period of time, the Reserve Bank has built several institutional mechanisms to deal with that. Number one, of course, is that I think competition is very, very important. Which is why if you look at, we did mention about the new 11 banks that we've licensed, about 11 payments banks and 10 small finance banks that we've licensed recently. That adds to competition, and possibly, it will improve the overall credit culture, because you also need to penetrate your credit deeply to be able to create a good credit culture in the country. The second part, of course, is we have also issued a draft guideline on universal bank licensing. Hopefully we'll come with the final guidelines soon. It's going to therefore have more players in that space, so more competition there. The other part is, I think, the credit information companies have kind of got traction today. So we originally began with CIBIL as a established on a non-legislative basis. Subsequently, the SICRA was passed, and we have 4 credit information companies there. We had a fundamental problem there, because there were the credit information companies that came later had very little information. So if anybody pulled an information from that credit information company, you could not get a complete picture. So we have asked now all banks to be members of all credit institutions, so that you pull information from any particular company, you will always get the complete data. In fact, I thought even the entire MFI guidelines that we issued has an important bearing on credit culture. We talked in terms of linking the total credit to the income of the person. There is a limit in terms of number of lenders to that person. There is limit in terms of there's a prohibition of accepting, of taking collateral from those kind of people. And so that the whole idea being there is no over-indebtedness, and at the same time, credit is being purveyed to the kind of people who would otherwise not been accessing credit from the formal sector. So that is the other element that we've done. And the third is that we also know that when we have a problem in the credit system, we need to find solutions. And therefore, over the last 2 years, 2014 February onwards, the Reserve Bank has been taking a series of measures
to deal with stressed assets, we began with, that's another part of the credit culture that we have, is that the banks do look for regulations for everything. So we had to clarify to banks that you could lend for a project up to 25 years or 85% of its life. Otherwise, the banks artificially curtail the gestation to 14, 15 years, which may not be consistent with the cash flows that the particular project will generate. Then we came with this idea of SDR, which is where the banks could change the promoter. And more recently, we came out with the guideline, which is now the acronym is S4A, where one could do a restructuring without a change in the promoter. And apart from that, we also have to deal with the recalcitrant borrowers. To deal with the recalcitrant borrowers, we put in place the entire framework of declaring someone as a willful defaulter, declaring someone as a non-cooperative borrower, of course after following a detailed process, which would actually entail, which would result in that borrower being denied credit or cost of credit for that borrower going up. The idea being that, again, you instill a sense of compliance among the borrowers. So I thought, why I'm saying this is, there are very many measures through which you also influence the overall credit culture in the economy. We of course have the legal systems like the DRT. We have the SARFAESI Act to deal with delinquent borrowers, and very recently the government has passed the IBC, the bankruptcy code. All these are important ingredients that will possibly have a big impact on the credit culture of the country. We can go on and on this area, but suffice to say here that the financial system in a country is going to be as good as the overall credit culture in their society, and that credit culture has to be one both within the lending institution as also in the society as a whole, and the regulators or the government can provide the kind of framework which will have a big influence on the credit culture. And the Reserve Bank will continue to work in that direction to improve the credit culture and the ability of banks to resolve stress assets. Thank you very much.
Thank you, Deputy Governor. Can I request Deputy Governor to be on the stage for a group picture with our host, Sandeep Ghosh, and can I request our sponsors Anurag and Sandeep to also join us?
Thank you. Okay. Good.
Thank you so much, sir, for coming in. Thank you.
Okay. Yeah.